Thank you so much for joining me on Trading Day. It's all about the Canadian banks today. National and Royal Bank trading higher. Let's get perspective on what to do with these bank stocks and what the earnings showed in terms of strength, as National in particular hitting a fresh all-time high. We've got Paul Bagnall on deck, and for shareholder perspective, we have Jamie Murray, head of Murray Wealth Group, and James Telfser, portfolio manager at Aventine Investment Council. Paul, why don't we start with you? Go through the results as you often do. Royal was a little bit messier, and National being called best in class.
Yeah, as the National, we'll get to that. We'll get to that one in just a moment. But National clobbered earnings per share expectations, and I've got some analyst insight on where the beat occurred. Let's begin with Royal. Here's this was the first set of bank results to hit the screens very early this morning at about 6 a.m. or so. $2.85 in earnings per share, 5 cents more than expected. So not a big beat, but given what we've seen thus far from other Canadian banks, investors we're happy to see it. Matthew Lee is an analyst at Canaccord Genuity. He says that this was largely, and we heard this from other analysts as well, largely a capital markets story. Capital markets pre-tax, pre-provision profit topped his estimates, but it's largely an expense story. Lower non-interest expenses is what drove things higher on capital markets, certainly versus expectations. Revenue, he says, in that segment was in line with his expectations. We saw modest increases in personal commercial banking profit at Royal Bank of Canada. Here comes National, and here you'll see a wide earnings beat with the company reporting $2.59 in earnings per share versus $2.35 as an expectation. So that would explain the big move up in shares of National Bank of Canada. Matthew Lee, again at Canaccord Genuity, says the beat was largely due to higher revenue, while expenses were also higher, but revenue grew more than expenses did, and that's certainly the trend that you want to see. There we see the stock up 3.5% today. There it is over 3 years to a new high. In personal and commercial banking, it's largely a Quebec story there. Revenue was up 5%. That's good news. And this bank, while it is smaller, of course, than the big five, also has an outsized presence in capital markets. Capital markets pre-tax, pre-provision profit beat Matthew Lee's estimates on higher revenues. So not just a cost control story, but a revenue story in capital markets at National Bank of Canada.
And we know peers capital markets has been a tricky part of the business, so National certainly exceeding its peers. Thanks so much, Paul Bagnall, for that rundown. On the desk with me, as I mentioned, I've got James Telfser and Jamie Murray. I'll start with you, James, because you're a shareholder in Royal. Did you like what you saw out of this quarter? Are you expecting better results in the future?
Yeah, I would say the best way to look at it is our expectations were quite low for the quarter, like all of the banks. So we didn't expect much from the banks, but it was a little bit better than expected. We liked what we heard on the call today, and it gave us no reason to move off of our position. But it certainly didn't drive us to buy more of the stock today. It's not something that we don't think the banks are set up for a particularly fantastic 2024. There's so many other opportunities out there, even within financials. But we thought the banks held their own, and we were pleasantly surprised to see that it wasn't some kind of blow off in provisions or anything like that. The commercial real estate side, which worried us a bit heading into the quarter, was stable. It was a little not unexpected.
It's still a problem spot, to be sure, but to your point, it's not getting worse or more extreme than you expected.
Exactly, and we think that we're going to have to see some stabilization in the provision for credit losses before these banks can recharge on some multiple expansion as we head through 2024.
You don't own RBC, Jamie, but you do own TD and Scotia. What's the aversion to Royal and the favoring of TD and Scotia?
I don't think it's so much an aversion to Royal. I mean, the Canadian banks, as we see, they tend to trade pretty closely over the medium to long term. We definitely like Scotia's dividend. That's where we hold it. It's in our dividend fund. And we think the new CEO there is doing a great job turning around the company. Scotia, again, very low expectations, which they beat. We think that that's going to be the story for Scotia going forward, is low expectations and continual small improvements. And then TD, we've just always been a big fan of the management team there, and recognizing that they have some headwinds right now in the U.S. and we'll see how they work through those and they report tomorrow.
So that's interesting. Are you confident in management? There was an analyst at Jefferies, John Aiken, longtime bank analyst, who questioned whether the confidence is still there with Masrani and others at TD, given it seems like they're having issues, doing deals in the United States.
Yeah, and certainly that was a hit to confidence. We think that they're going to work through these. It is going to be a little bit messy, I think, in the U.S. for TD over the next year or so. But given the strength of their Canadian franchise, we think they can continue to build on that. They've always been an innovative company in the banking space, and we think that they'll find ways to keep growing. So
there's parallels there. TD, Royal, they got that exposure in Canada, which seems to be stable. We'll see for TD. It certainly was fine for Royal here, and they're bulking up with HSBC Canada. That U.S. exposure is something that they talked about on the conference call. City National, of course, has been challenged over the past couple of quarters. Part of it is a consequence of what happened with Silicon Valley Bank. David Mackay on the conference call promised 2025, it's going to get so much better. Do you believe that?
Absolutely. I mean, this was an asset that we were quite excited about when they made the purchase back in, was it 2015 or 2016? And there's a lot of growth there. And so the growth is what caused some of the problems. And we believe that a lot of the issues that happened on the balance sheet were common across a number of different banks. It could have been managed a little bit better, but we like to hear when a CEO takes the hits on it and given our experience with Royal Bank, we think that this will drive them to do better next year, and it'll probably help with the HSBC acquisition as well.
Generally in the banks, we're seeing provisions go up. So, storm clouds, and perhaps that's natural. They're just provisioning for a slowing economy, maybe some job losses. There was a question on the call by TD's Mario Mendonca, which I thought was interesting. They're only just now going up, even though the rate hikes, happened quite some time ago. Now, what is the expectation that those PCLs are going to come right back down when those rate cuts happen? He didn't actually get quite a good answer, but so I'd love to get your take on how quickly that money can fall back to the bottom line when we start cutting rates.
Well, look, if you would have told me that we'd be in the situation we are now with the banks where we're muddling through this environment after jacking interest rates up 4%, I would have told you you're crazy, but we're here now. And so how quickly is it going to come down? It's probably going to come down a little bit quicker than we expect because there was so much money in the system to absorb these higher interest rates, but it's not going to come down, drop off a cliff. It's going to take quarters still to work that through. We still haven't seen the peak of that yet. So we believe that we still haven't seen the peak as mortgages come due and the economy isn't exactly coming from a period of strength right now, particularly in Canada with their commercial banking unit. So we should see PCLs continue to be manageable, but they're not going to fall off a cliff just yet.
And A, do you agree with that, Jamie? And B, is that going to mean slower dividend growth? What is that going to mean in terms of how they use their capital?
Yeah, and I think we agree with that sentiment. We have seen the PCLs come in even above expectations, but capital is also coming in better than expected for most banks that have reported so far. And we're still seeing the profits, except for at BMO, meet or beat expectations. So even though we are seeing those credit provisions come in, things are still, as we said, chugging along. And when we do get these interest rate cuts that we think are coming in sometime in the back half of 24, it's just a matter of time until that reverses.
Let's talk National. Neither of you own it, and it's doing everything you want to see a bank do, growing its net interest margins when that was a problem spot for some of the other banks. Growing revenue faster than expenses, growing capital markets, and that was challenged for everybody else. They're the best performing stock so far out of the major banks in 24. It's an all-time high. Where's the knock?
Yeah, well, from our perspective, there's no knock there at all, right? We're sector agnostic, so we don't own plus or minus a few banks. We've held Royal Bank for many, many years on behalf of clients. It's to be perfectly honest, the last few quarters or the last year, I should say, has caused us to rethink our thesis on National Bank as a potential addition to client portfolios. But
as a more long-term, less peripheral.
Exactly, but as we've evaluated the banks over the last few quarters, we've decided that there's better places to park our capital than in the Canadian banking sector. But it certainly has impressed us and caused us to rethink that view.
What about you?
Yeah, and I think it's a trend that we're seeing some of these smaller financial companies in Canada take market share. Like Equitable Bank as well has been a great performer, and as these companies continue to grow and grow, that's the question: is once they start hanging with the big boys, do they keep outperforming, or do you eventually fall back into that peer group trap?
What about this whole thesis that, you like these Canadian banks with U.S. exposure? That was very in vogue a couple of years ago. But now these banks with U.S. exposure are running into a bit of trouble. Is this just a temporary blip? Is that still the right strategy when you're thinking about owning these Canadian banks? Because we're looking at EQB and National managing to do just fine in their domestic markets.
Yeah, I mean, well, we actually own BMO in our Global Equity Growth Fund, and that's exactly why we own it, is we like the Bank of the West acquisition. There's a lot of synergies that's going to come through, and at the end of the day, we do view banking over the longer term as a scale game, and the U.S., we're more positive on the U.S. economy longer term, so we think you can get that exposure there, then that's where you want to be.
You agree?
100% agree. I mean, we need earnings growth. Mind you, our population is growing quite rapidly in Canada, which is nice, but nowhere near as much of a market as the U.S. So you need that exposure, and all of these are learning lessons. It's been volatile over the last few years, but I think that'll make these stronger franchises going forward.
All right, we're going to